Before we begin, I'll share some housekeeping information. We're conducting this town hall in webinar mode. That means you're going to see and hear only the presenters. That's to minimize distractions and any background noise so that you enjoy the best experience possible. We welcome your questions at any time during this webinar. Open the Q&A box and type in your question. And at the end, we'll answer as many as we can. If time runs out, we'll reach out to you afterwards. Want to let you know that today's town hall is being recorded. You can view the recording and download the accompanying slides on our website, probably by tomorrow. And finally, our usual disclaimer, everything that you hear and see in this town hall should not be construed as offering any investment, legal, accounting, or tax advice. Always consult your own advisor or the appropriate professional for those kinds of questions. Well, let's begin. Welcome on the second day of Lent to the United Church Funds Town Hall, where we'll be recapping the fourth quarter of 2023. I'm Charles Buck, President and CEO of United Church Funds. We're going to start right off with a poll, and you should see popping up on your screen a question about goals or priorities for the coming year in your church organization, kind of a New Year's resolution question. If you can't see the whole poll, try scrolling down or widening the borders. I'll give you a moment to mark your choices here. And while you're doing that, I want to publicly acknowledge Debbie Weibo and Adam Sank of our marketing and communications team for their excellent support of all of these town hall webinars. They do everything from the registration to the administration, from overall direction, to this poll production. So I want to say thank you, Debbie and Adam. So if you would just mark your choices, we'll see what we've got. Your top priorities for your church or organization 2024. Most of these are probably geared toward churches, but maybe they apply to your organization as well. And remember that you can mark more than one. So the results should be coming up fairly soon, and we see that growing attendance or membership is one of the highest priorities for our attendees today. Makes a lot of sense, followed by growing the endowment or a focus on the financial stewardship of your church or organization, and then also fostering a culture of inclusivity and diversity. So these are all good goals, and glad to see this. Hope this is something that you're able to achieve this year. I want to tell some of you may remember a year ago or so in one of these polls, we asked what you saw ahead for the economy. A fair number of you thought that we were headed for recession, and many economists agreed with you. But as you know, we seem to be experiencing a soft landing. That is, we've managed to stave off that recession for various reasons, including strong consumer demand and confidence. And I think perhaps the priorities in our churches may be indicative of some of that confidence. So at UCF, we make it our priority to help you with all of your mission priorities, regardless of what's happening in the world and the markets. We are long-term investors. That means we also take seriously the idea of sustainability. We strive to invest sustainably for your assets, for the world, and for the future. You can learn how we invested in that sustainable future in our 2023 annual report, which is coming out in a few weeks. Until then, in this town hall, we'll share how we're helping you sustain your mission and how together we're ensuring a sustainable future for all. It takes a team to do all of that, and I'm pleased to introduce some of that team today and to thank them for being here. You'll hear from Matthew Ilian, our Director of Responsible Investing. Also from the investment team of the Pension Board's UCC, Dave Klassen, Lon Kai, and Aminati Dhanaraj. We're going to introduce Kelsey Rose, one of our newest team members from our institutional relationships team, and of course, Matt Wagner, UCF's Vice President for Institutional Relationships. Now, those of you who have been with us before will notice that Stacy Pettis is not here. Sadly, there was a death in her family, and her family is gathered today. So we send Stacy our love, and we look forward to seeing her next time. Finally, my thanks to all of you for trusting us to be your partners in faithful and sustainable stewardship. And we'll turn now to Matt Wagner for organizational updates.
Thanks, Charles, and welcome to all of our participants and to my fellow staff members. Look forward to spending the next 40 minutes or so with you, unpacking all of the work that we're doing around responsible investing, as well as the work that we're doing in the portfolios to generate competitive and values-aligned returns. I would just note, I looked in the Q&A, and Thomas Pierce mentioned that in the poll question, his church marked the other category and mentioned to us that other for them meant safety and security of their worship space for their members, and such an admirable goal. And as we know, gun violence plagues our society. Recently, of course, this week in Kansas City, and that's part of the main reason why we divest our portfolio from firearms and other weapons of war, so that we can promote peace not only here but overseas. Before I introduce Matthew Illian to talk more about responsible investing, I have just a couple of updates to provide to you all. First and foremost, we did welcome 2 new team members over the last handful of months. Michael Zivanoff joined our team as a junior accountant and has really hit the ground running behind the scenes, helping our clients with withdrawals and other deposits and other transactions. He's a joy to work with. And joining us on this call is my colleague on our institutional relationships team, Kelsey Rose. I'd like to turn the floor over, Kelsey, to you briefly for you to introduce yourself to the participants.
All right, thanks, Matt. Hello, everyone. My name is Kelsey Rose, and I'm very excited to be working on the institutional relationships team with United Church Funds. I have admired and appreciated the work of United Church Funds for many years while I was in my previous role at Global Ministries, which is the shared ministry of the United Church of Christ and Christian Church Disciples of Christ, where I worked in the resource development office for almost 9 years. But I am grateful to be a part of this important work. I love that it helps all aspects of the church and denomination to fund their mission and ministry through investments, and really getting to see our shared values represented through the responsible investing work. So it's nice to meet all of you in this virtual way. Please feel free to reach out and say hello, and I hope we do get a chance to work together soon. Thanks.
Thanks so much, Kelsey. And again, as we add to our staff and as we add to our capabilities at United Church Funds, one of the ways that we like to be able to engage with you all is to be able to get out on the road and see you all in person at various meetings. Stacy Pettis will be at a large meeting in New Hampshire called Prepared to Serve on February the 25th. And both Stacy and I will be at the Council for Health and Human Service Ministries annual meeting, which will take place in March in St. Louis. If you happen to be planning on attending one of those meetings, make sure you come find us, reach out. We'd love to have a discussion with you. The final organizational update that we have for you today is we took a look at the last 5 years of our expense ratios. As you might remember, the expense ratios of all of our funds represent a cumulative fee, fully inclusive of all investment and administrative charges. It's the only fee that we charge at United Church Funds. But we did a 5-year look back from 2019 through 2024 and found that on average, we at United Church Funds have been able to decrease the average fee for one of our funds by over 9%. We've decreased fees significantly for several of our, over 15% for several of our funds, but every fund at United Church Funds has actually seen a decrease in fees over the last 5 years. And what does that mean for all of you? Well, that means you have the opportunity to return more money for mission and ministry, to be able to support your church, to support your operations, and hopefully to be able to fund those growth initiatives that you saw in the poll question related to engaging new members. With that, I'm going to turn over the floor to my colleague, Matthew Illian. Matthew is our Director of Responsible Investing, and he has some exciting updates around the way that we craft portfolios to be aligned with your values. Matthew?
Thank you, Matt. Greetings, everyone. Here at UCF, we've been thinking a lot about our name and mission. And in particular, we've been focused on the word united in United Church Funds. This particularly plays out with our responsible investing work, because unity means that we're stronger when we're standing together on important issues. By investing together with shared mission, with shared values, we're seeking a more just and sustainable future. So before I get started, I really just want to thank all of you for your support. Like I said, this corporate engagement work wouldn't be possible if we didn't have that united support from all of you. So one of the areas that we have focused in on recently is a living wage. What is a living wage? It's basically earning enough money to afford a modest standard of living. It's being able to pay your bills and feel secure. Only about half of jobs these days pay a living wage for those with children. As costs of housing and other expenses differ from region to region, we found MIT offers a great living wage calculator where you can search by county or city and see what the living wages are where you live. You can search for workers with no dependents as well as parents with children. You can see on the slide here that the national average for living wage is $25.02. Now that's for a family of 4 with 2 working adults, before taxes. So that's certainly higher than the minimum wage, which ranges from anywhere from $7.25 in some states all the way up to $16 in others. But we have joined with the Interfaith Center on Corporate Responsibility in calling for all corporations, all companies to move towards paying a living wage, both for their direct employees and their contract workers. We are sharing this letter that we've signed along with 136 other investors representing $4.5 trillion in assets with corporations like Dollar Tree, and asking them what they are doing to move towards paying a living wage. We do see this as a justice issue, but when we speak with these corporations, we generally focus on the business case for a living wage. We're bringing up things like the boycotts that are happening, and as well as the union efforts. And we're encouraging all corporations to consider redoubling their efforts so they can attract and retain an engaged workforce. In addition to supporting a living wage, those of you who have listened to our many town halls will know that we also file shareholder resolutions. And this year we have filed 10 shareholder resolutions to bring attention to critical issues, ranging from environmental issues, social issues, governance issues. So far this year, we've reached settlement on 2 of these resolutions. The first is with Analog Devices. They make semiconductor chips. And the concern that the public and investors had is that these technologies were showing up in Russian weapons. The Analog Devices agreed to update their Know Your Customer protocols and training for all employees. And they also agreed to conduct a third-party human rights audit. And that led to us withdrawing that resolution. So it will not be going to a vote because we felt the corporation was committed to making progress. Another agreement that we came to was with State Street. We were concerned there that their proxy voting they're one of the largest asset owners in the world, next to BlackRock, Vanguard, up there with Fidelity, and which means they own a lot of shares, and their votes on particularly environmental and social issues we saw them decreasing over the last year in particular. And we had concerns about this and wanted to make sure that they knew that many investors and clients still believe that they should be supporting these issues. State Street agreed with us to update their policies and also allow us to speak with this on this issue at the next shareholder meeting, as well as share a letter with their board of directors calling attention to this issue. And so we agreed to withdraw the resolution. You can see we had a number of other issue areas that we're covering, and I don't have time to go into them all today. Each has a story. In fact, I was on calls with Facebook or Meta and HCA today. So I imagine some of these will go to a vote, and some others will probably lead to a withdrawal. Feel free to reach out to anyone on our team and myself in particular if you have, particular interest on any of these corporate engagements and shareholder resolutions. So now I want to turn and share a clip from an interview that we did with Fiona Reynolds. Fiona is a rock star in the world of responsible investing. She was named as one of the 20 most influential people in sustainability globally by Barron's. And you can see that she was CEO of the Principles for Responsible Investment, or PRI, for nearly a decade. She has helped influence and shape many of the expectations that corporations have today. And we were privileged that she agreed to an interview. We interviewed her on a number of topics. And there was one segment in particular that we want to share with you. We can't share the whole interview, but the question that she's answering in this segment is, how can churches and their investment decisions impact the world? You hear a lot from us. We wanted you to hear from Fiona Reynolds.
A really important thing is that governments alone are not going to solve the problems that we have. They're not going to be able to fund all of the Sustainable Development Goals, for example. We know that we need more than US 3 to 5 trillion annually to meet the SDGs. So that isn't just going to come from government. That means we need the private sector, governments, NGOs, etc., all working together and all moving in the same direction. But really.
So that we have, like I said, it's a much longer interview. There's 6 other segments that are on our website, and I would encourage you to go to our news updates and hear all of Fiona's insights. But to check and make sure everybody was listening, we wanted to ask a poll question or trivia here. How much money is required to meet the Sustainable Development Goal funding? Did she say, was it 3 to 5 million annually, 3 to 5 billion annually, 3 to 5 trillion, or more than that, more than $5 trillion? And these Sustainable Development Goals were goals set by the UN to essentially say what kind of funding and support do we need to achieve a sustainable future. And that's in terms of clean air, drinking water, all of these different things. So let's see, Debbie, when we're ready, we can turn to the results of this question. All right, most of you got it. It's $3 to $5 trillion annually is what's needed. And her point there is that, the governments cannot do this alone, and nonprofits can't do this alone. It really takes the support of the private sector, and in particular, investors. And with that, I'm going to turn the presentation back to my colleague, Matt Wagner.
Thanks, Matthew. I got the full question right. I was listening, so happy for myself, I guess, and happy that everyone was also tuning in. Thank you for bringing us that interview that you did with Fiona, and I would encourage others to go to our website to see the full interview. It really is quite fascinating. As we move to the next couple of slides, I want to go through some themes from 2023. We'll go through some index returns, and then we'll bring in our investment team, Dave Clausen, Manothi Dhanaraj, and Lon Kai, to answer some questions. First things first, the themes are here. You see them. 2023 was a nice rebound after of course, what was a very challenging year in both equities and fixed income in 2022. One of the themes that came out of the equity returns was the idea of this quote unquote magnificent seven. Tesla, Google, Facebook, Nvidia, Microsoft, Amazon, and Apple. I have my list here just to make sure I didn't forget any of those. Those seven stocks generated over 80% of the total return of the S&P 500. The other 493 companies were cumulatively were positive, but returned much less than those seven stocks. So that narrow rally, while we did certainly take advantage of it, I think it's safe to say, and we're going to hear from Dave and the team later, safe to say, though, that it's a difficult time in equities to be able to sort of stick your neck out too much on the risk curve, knowing that the bulk of that return was generated from a narrow group of equity of stocks. On the fixed income side, we saw a little bit more rate normalization. In fact, a significant rate decline during the last couple of months of the year. The 10-year Treasury essentially was fairly flat throughout the year, allowed bond investors with rates up to be able to generate a healthy single-digit return after, again, what was a very challenging 2022. Lastly, I would just remind everyone on this call that whether markets are up or markets are down, whether we're overweight to stocks or even maybe overweight to fixed income or alternatives, the same work that we're doing around responsible investing happens every single day at United Church Funds. We are committed to doing that work, and in addition to providing you a competitive rate of return. And so we want to make sure that always we focus on both ends of that spectrum. As we flip to the next page, you'll see some index returns. These might be difficult to read on your screen, but you can see on the chart on the left, the second column from the left, nearly all green numbers across various indexes and stocks, which are towards the top of the page, bond indexes, which are towards the middle, with the exception of that commodities index at the very bottom, the only red number on the chart for 2023. You'll see that we did have robust equity returns over the course of the year, north of 20% for the north of 25% for the S&P 500, certainly north in the neighborhood of 20% for developed markets. Small cap stocks up about 16.5%, and emerging market equity, which has historically been a more risky asset class, returning around 10%. You can see most of those bond indexes there, starting with Barclays and JPM. Those were all up mid-single digits to high single digits. And then in the bottom right, you'll note there the interest rates for the year. Again, 10-year Treasury essentially flat for the course of the year, but we saw in the fourth quarter and specifically over that last month, rates came down fairly significantly, which impacted our year-end number. As we move to the next slide, I'd like to bring in my colleague Lan Kai to respond to this slide. So what we're looking at here is a sort of a standard or a model 60-40 portfolio. And this should mean something to our clients because the UCF Balanced Fund and the Beyond Fossil Fuels Balanced Fund both rely on that target allocation of 60-40. Of course, our funds have the benefit of flexibility from your team, Lon, to go plus or minus 10% from that 60-40 target, allowing you and our investors to take advantage of or steer around market conditions. We ended 2023 about 5% overweight to equities, 5% underweight to fixed income. Talk a little bit about our current allocation, a little bit overweight to equities, a little underweight to fixed income, and where we see that moving from here.
Thank you, Matt, for the question. So at this moment, the UCF Balance Fund is close to 67% in the equity, so about 7% overweight. And then the fixed income is 34%, so close to the benchmark weight of 30. It's a 35%, so closer to the benchmark. We're still kind of 5% underweight. In the 2023 timeframe, like you said, we tried to shift the asset allocation somewhat to capture a cycle-aware market dynamics. And in 2023, we started the year slightly overweight equity, And we trimmed the overweight in July, late July. As you recall, there's a quite good run early part of the year. And then towards the end, the last quarter, we kind of let the equity market go further. At this moment, we are using the inflows from the new client, try to trim down the equity overweight somewhat. And that's kind of the positioning that we're taking. And also in 2023, we actually added into the fixed income in late September, October. If you take a look at the fixed income market over 2023, the return largely came from the last 2 months of the year. So it was actually negative before the last 2 months. So we kind of positioned that well too. So I think for the balance fund, where investors looking at 60-40, we try to tactically do the asset allocation, not too often, but to generate alpha from the technical asset allocation and then from manager selection. I think there is a question in the Q&A. If you don't mind, I just address very quickly here. Because the question is probably regarding the 18% 60-40 portfolio that you see here. And then for UCF, it's about 16.5 for the BFF balance fund, and then 14.5 for the UCF balance fund. This 60-40 is a combination of US equities and then bond. And as people see that over the last 10 years, US equity, particularly S&P 500, has outperformed all other regions in the world. Therefore, yeah, that's kind of difference coming from.
Terrific. Thanks, Lon. I'll use this as a reminder for everyone. If you have questions, there's a Q&A button at the bottom of the screen. I encourage you to throw your questions in there, and we will make every attempt to get to as many questions as we possibly can, both through the presentation as well as at the end. Lon, I have, let's go ahead and handle one more question on the fly. We just had one come in. The person that asked it noted that you mentioned that we were at about 67% equities. That person had a question as to whether that was an intentional overweight or just because the growth of equities versus fixed income pushed us a little bit to that overweight allocation.
So as we trimmed down the equity overweight in July, we still have 2.5% overweight. So the rest of the close to 4-5% is a big rally from the equity, which I think the investor benefit from that.
Clearly, and I hope for everyone that's on the call, please know that Dave and Lon and Menothi are watching our portfolio carefully every day, monitoring our managers to make sure, well, to do our best to optimally allocate the balance funds and our other fund options. Thank you, Lon. As we move to the next slide, this is a slide that goes all the way back to 1996, and it's the price and the S&P 500 value. You can see if you go all the way to the far right, the slide ends on December 31, 2023, where the S&P 500 ended the year at 4770. This shows that fairly significant and healthy recovery in 2023. Again, driven by that narrow group of market leaders, as I mentioned before. As we move to the next slide, let's drill down a little bit about just how much the impact of those top 10 this is a top 10 list, but top 10 performers had on the broader S&P 500. I want to bring Menothi in. Good to see you, Menothi. Thank you for joining us. Can you talk to our participants a little bit about the outlook for 2024 for equities, maybe some of the key data points that we are looking at to see if this recovery that we had in 2023 will continue into 2024, and if we might broaden that recovery a little bit to include more than just the growthy tech names?
Thank you, Matt, and that's a great question. As you noted and Lon noted, last year was a very narrow market with the top 10 stocks contributing 86% of the return, but I did want to point out that the rest of the market still did have an 8% return, which is close to the historical average of the index. What we did start to see in the fourth quarter was a broadening in the market where small caps actually outperform large cap stocks, but thus far this year, it started to reverse back to the large caps outperforming. Generally, small cap valuations are very cheap relative to large cap stocks. And we could start to see some outperformance if we start to see slowing inflation as well as earnings growth in those stocks. From a sector perspective, we could also see some broadening if the yield environment improves for defensive stocks such as utilities, as well as long duration stocks such as technology and communication services. Generally, if investors keep an eye for indicators such as GDP growth, unemployment, and interest rates, it's very important. I think this year is going to be a bit different because we will potentially see some volatility given the continuing tensions geopolitically, as well as the US elections that are coming up this year. So going to your question about the outlook for the US equity markets, investors' expectations at the beginning of this year had a wide range, but kind of averaged around mid-single digits for the year. We've already seen that return thus far in a month and a half of the year. So it's hard to predict for the full year, but we expect to see some volatility because of the US elections and the geopolitical tensions.
Thanks for that, Manothi. I know when we do portfolio reviews for clients, everyone wants to know sort of this time of year, sort of what our expectations are. And it's an incredibly challenging time. As you mentioned, the global conflicts that we have, not only in Russia and Ukraine, but also in the Middle East, the impacts to shipping and trade around the Red Sea, and of course, our country's relationship with China and Taiwan makes it a very difficult, sort of a murky globe, if you will, to be able to find some real answers. I know that our team is watching the portfolio very diligently, and I thank you for being with us today. Grateful that you were able to share. We're going to look at the last slide, and I'm going to bring in Dave Clausen. Dave, I just mentioned that our institutional relationship staff meets with our clients all the time. And one of the things that comes up in almost every one of those meetings is the topic of inflation. And of course, we know that inflation, and Dave, you've served on investment committees for churches and other organizations. You know that inflation hits budgets hard, cost of living adjustments for staff, operational expenses are up, not to mention the potential negative impact that inflation can have on giving trends. So this is something that is serious for our clients and something that we want to be able to address in today's town hall. While inflation has certainly come down since those highs in sort of the mid-2022, my question for you is this. We're looking at milder inflation, maybe a more normalized interest rate environment. How is that impacting our investment strategy, and thoughts on overall 2024 returns for both equities and fixed income?
Yeah, great question. I feel like these are all related and highly topical. And just to reiterate what Lon mentioned, we did take advantage of the spike in interest rates last year to do a couple of different things, and those include really under the broad category of increasing duration, that is interest rate exposure. So in the fixed income fund, we actually reduced and eliminated our bank loan position. And bank loans, for those of you who know, have zero interest rate exposure, a quarter of a year. We migrated that strategy from bank loans into a PIMCO ESG solution, which has more duration and more flexibility. Second thing is, as Lon alluded to, we did add to our fixed income exposure. No doubt inflation has come down, as you can see here, from the peaks 2022. High single digits down to the 3% range. Our own view of things coming into the year was really that interest rates had overshot to the downside, and we've seen a real backup in rates. And our best guess is that interest rates and inflation will stabilize, but at a higher rate than what's expected by the Fed, and you're starting to see that. But it will vary and oscillate. So fixed income not quite as attractive as it was at our entry point, earlier in 2023. But if you look at the yield, the starting yield on the fixed income fund is somewhere in the 5% range. So that's a reasonable expectation without any movement on the rate side. And I think, Manothi accurately points out that expectations are in the high single digits. So we feel like the risk return is a little less than it was, less than it was a year ago, but we could still expect, mid to high single digits for a balanced portfolio, given all that we've got going on. And finally, Matt, I know there are a couple of questions in the chat, but I think the approach to active management is an important one, because if you're looking at fundamentally at the dynamics of a corporation, of course we want to pay a living wage and we want to have the organization be sustainable, but stock selection in navigating these kinds of environments of higher inflation will enable a diversified portfolio of stocks in particular to help keep pace with those rates of inflation should they pick up again.
No doubt, appreciate that. And to your point, we had a question in the chat regarding the equity portion of the balance fund.
Yeah.
That return, and kind of the question specifically was, did we find that satisfactory? I will tell you that as we looked at year-end returns as our clients did, I think we had a lot of satisfied observers. I think they should have been, but just to put a finer point on that, to talk about sort of that active management piece. As many of our clients know, we use recognized benchmarks. We use custom indexes for our balanced funds. And then we have this separate group where we also benchmark our performance against what we call the Lipper peer category.
Right.
And Dave and your team have been instrumental in helping our clients understand this. But essentially, that's the median performance of a large group of managers that are trying to do the same thing that we are. Kind of puts us up against our peers, if you will. The total equity fund, which is the equity portion of the balance fund, up 20.44% for the year. Slightly under benchmark, but ahead of its peer group by 310 basis points. For those non-financial folks, that's 3.1% over the course of a year. That is really strong outperformance on the equity side. Dave, to your point, due to the way in which your team is manipulating the portfolio, overweighting and underweighting managers, and looking at the various constructs of equity, U.S. large cap, small cap, and international, that we could have in the portfolio.
Right, and everyone is using this Magnificent Seven as an excuse for why managers underperform, perhaps. But when you look and drill down into the component and the part of the UCF balanced portfolio, which is dedicated to large U.S. stocks,
yep,
we actually were ahead of the S&P 500 without having that level of concentration. That's primarily due to having only two managers, an index manager and a quantitative manager, who actually added value. So we actually, positioned the portfolio fairly well, even for this type of environment. So no excuses here.
No doubt. And by the way, I would just note and remind all of our folks on the call that is net of fee performance. So net of fees, our domestic core equity fund, which is our large cap fund, ahead of the S&P 500. And I will also note, while it's a smaller portion of most portfolios at UCF, our small cap equity fund, which is led by a couple of terrific managers, one of which we had done a video a couple of years ago with Channing Capital, returned 18.34% for the year. That was ahead of its benchmark by over a point, and ahead of its peer group by almost a 3 percentage point gap there. So a lot of overperformance to look at in 2023. And with that, I think I'm going to ask Adam to thank you, Adam. Move the slide. We're going to look at a couple of the different questions that have come in. I got a great question from Carrie Sandusky. Carrie, I understand that you're watching with the rest of your investment committee. Thank you for joining us. That is great. We will use you as the model for all other churches to be able to get folks together to watch this. You had a question on fees and sort of what the average fee might be. Woodrow Whitlow also had this had this question as well. We talk about expense ratios at United Church Funds. Again, every one of our funds, with the exception of our cash and equivalents fund, which for which we do not charge an expense ratio, has this annualized small fraction that we take to cover our expenses at UCF. Remember, we're a not-for-profit organization, so we're covering our expenses with those expense ratios. The average client at UCF is typically paying between 75 and 85 basis points as an all-in expense ratio. So that's 0.75% to 0.85%. Our UCF balanced fund is at 0.82%. Our Beyond Fossil Fuels balanced fund, these are two very popular options, is at 0.77%. Just want to double check my notes to make sure that I'm right. Those are for 2024. So what we're trying to do at UCF as we grow in assets, we crossed the $1 billion mark in total assets under advisement earlier this year. What we are trying to do is to be able to control our cost while making sure that we're providing you with an excellent service model, so that we can hopefully over time, as I mentioned earlier, across the last 5 years, lower our fee structure for our clients, because at the end of the day, that is because that allows you to put more money into ministry. A couple other questions from Stephen Hotchkiss. Matthew, I might bring you in on this just to double check and clarify, but you talked about $25 an hour, meaning a living wage. Stephen wants to clarify that is for approximately a 2,000 hour work year, correct?
That's right. Yeah.
That's perfect.
Yeah, about $50,000 if you have kids, is what it takes, and then two parents earning that to put the kids through daycare and all the other housing expenses, etc. On average, it goes up and down depending on where in the country you live.
Sure. Thank you for that. And I'll bring in a member of our investment team to maybe I'm not going to ask you to look in the magic mirror and give us the response, but we do have a question here about the Federal Reserve and interest rates, where we are in an election year. Curious to get your thoughts on Jerome Powell, whether we think there might be some increases in the federal funds rate, whether we will see decreases, or whether the chances are that they are going to remain the same. I don't know who wants to chime in, Dave, if you want to, or Lon, see you coming on screen.
Yeah, so I can quickly give what Jerome Powell said at FOMC meeting in January, that he is not expecting to cut interest rates in March. So the market has expected the Fed to cut 1.5% for 2024. It might be pretty aggressive because the Fed's own dot charts forecast for 3 cuts. The real answer probably be somewhere in between. And then the current expectation is that Fed will likely start to cut rates in June.
And of course, Jerome Powell was on 60 Minutes. What was that, about a month ago, talking about his strong desire to stay out of politics related to interest rate increases. And I think we can all wish him well in trying to do that in 2024. I think it's going to be hard to stay out of politics for almost anyone on any topic as we march towards November. We are at the top of our time. If there are questions, that I think we got to most of them throughout the course of the conversation. If you have a question that you'd like to pose to us, please feel free to email our staff. You can reach us at info@ucfunds.org. Those emails will be sent to our institutional relationships team, and we will be happy to follow up. I want to give a really warm welcome to all of my warm thank you rather to all of my colleagues on the call. We are all better for what you have shared today. I hope our clients have stronger ministries because of what we do with our portfolios. And at the end of the day, that is our mission at United Church Funds, to make sure that we are maximizing and optimizing portfolios, to make sure that when you go to church on Sunday, it's a vibrant experience. When you do your church work throughout the week, that you feel enthralled by that work, and that our portfolios can support your mission and ministry. I'm wishing you all a lovely Lenten season. Thank you all again for joining us, and have a great evening.